Welcome to Three Clowns, Episode 18, Tuesday, April 29th, FOMC-day. Oil's back above 110, and somehow the AI stocks that were supposed to own this market just got their teeth kicked in yesterday.
Yesterday, I saw a guy apologizing to a self-checkout machine, like it could blacklist him.
That's incredible. He's already auditioning for the AI overlords. Honestly, after looking at the productivity data yesterday, I might start being nicer to the ATM too.
Oil's back above 110 for the first time in 3 weeks, but the UAE just quit OPEC, which is already putting fresh jitter in the supply picture. Big tech got absolutely waxed yesterday. The QQQs down 1%, AMD down 3.4%, yields ticking higher. And frankly, the return on investment story on all this AI spending is starting to feel less inevitable. Meanwhile, defensives got a bid. Your staples, your REITs, classic risk-off rotation. Gold actually slipped despite everything happening with Iran, which tells you real yields are winning that argument right now. Small caps and the space names are getting demolished. Russell down 117, AST Space Mobile down nearly 7, Rocket Lab down 4.5. Jamie Dimon came out yesterday with a pretty pointed warning about a bond crisis brewing, which definitely gave that safety rotation another nudge. And it's not all macro dread. PepsiCo just made a $537 million bid for that Australian outdoor ad company, Media. So M&A is still showing up even in this tape. Vale missed on costs. The RAC pulled a £5 billion IPO in London. Ackman's pricing his latest deal at the low end. And over in China, the yuan's facing a real test this summer, with record dividend payouts about to hit the balance sheet. So the market walks into Powell and the FOMC at 2 o'clock today with all of this sitting right there on the table. He's got to either hold steady or blink. And everybody's going to be listening for which one it is. Tom, what are you seeing in the tone here?
Yeah, the story was AI makes everything cheaper so you can ignore input costs. Oil's at 110 and yields are rising at the same time. That's the part the model doesn't have. You're watching the belief system meet physics a little bit.
Physics is a very polite way to put it, Tom. Yesterday, I was looking at the gas pump and then diving into the PCE footnotes. And it's like the Fed thinks they finally got the fire contained in the basement. But oil at 110? That's just pure oxygen being pumped into the crawl space. If the supply side is breaking because the UAE just walked away from the table, Powell's higher for longer isn't a strategy anymore. It's a hostage situation for the consumer.
Right, so the belief system was inputs don't matter anymore. And now inputs are flashing red, and the Fed has to sit down at 2 o'clock and pretend they didn't notice. That's not a policy problem. That's a credibility problem. And the tape this morning is going to show you exactly where the market thinks this breaks. Let's go. All right, so here's what happened yesterday, and it's actually a pretty clean story if you step back. Oil climbed back above 110 for the first time in 3 weeks, the oil ETF up 3.6%. And on the surface, that sounds like a supply squeeze. But what really happened is the UAE just announced they're stepping back from OPEC production agreements. So instead of a tightening narrative, you've got supply uncertainty, which is almost worse. It spooked the bond market just enough to bump yields up about 3 basis points to 437. And once that happened, everything else falls into place. See, when your discount rate goes up, and that's what a yield move really is, it's the denominator in how you price future cash flows. The stocks that suffer most are the ones that don't have cash flows today. That's your big tech, your AI names. The QQs down 1%, AMD took a genuine 3.4% hit. This is ROI doubt creeping back in. All the CapEx spending that's been justified by AI upside suddenly has to clear a higher hurdle. That's real money. But here's the thing that's worth watching. Defensives got bid staples up 90 basis points, real estate up 97, but gold did, and the NT. Gold dropped. And that tells you the market doesn't actually think this is a geopolitical crisis or a long-duration inflation spiral. real yields moving higher is winning the argument over we need a hedge. It's a repricing, not a panic. REITs are the weird tell, though. REITs went up while yields went up. That shouldn't happen if rates are about to explode. What it tells you is the market thinks this move is contained, that income assets can survive in a higher rate world because rates aren't going to 450, they're going to stop somewhere around here. Investors betting on resilience, not disaster. Small caps got hammered. Russell down 1.17%, industrials down 89 basis points. And that's because small caps have zero margin cushion against higher input costs. Energy costs eat directly into the bottom line. Speculative space names, worthless in this environment. Rocket Lab down 4.5, AST down nearly 7. Those are names that exist on a hope and a prayer about future cash flows. Higher discount rate, they evaporate. Meanwhile, M&A is still happening. Pepsi just dropped $537 million on an Australian outdoor advertising platform called Media, which tells you at least some of the capital deployment machine hasn't frozen. Ackman's second IPO attempt is pricing at the low end. RAC pulled its £5 billion London float entirely. Vale missed on costs. Rising energy and input prices ate right into their margins, even as prices held up. That's the same squeeze we're watching in every corner of the commodities complex. So you've got this bifurcated picture. Strategic capital still moving. Speculative capital running for the exits. Tom, here's what I want to know. AMD's bouncing almost 1% pre-market right now. The QQs up 0.3. Is that a real reallocation or just short covering before the Fed decision at 2? Because if AI hardware can't hold a bounce on FOMC-day, that tells you something pretty important about where this repricing's actually going.
This is the episode 1 argument getting a little stress test. Oil pokes up, yields, twitch, and everyone briefly remembers inputs cost money. A 1% pre-market bounce isn't belief, that's people covering shorts before Powell starts speaking. If the story was actually broken, AMD wouldn't be allowed to be green at all.
Exactly. It's the I don't want to be holding a heavy short when Powell starts talking bounce. But the AI hardware drama is the shiny object. The real story is oil at 110 is an immediate regressive tax on every single person trying to get to work. That drain on the consumer doesn't show up in a tech earnings call until 3 months later. And the 10-year's sitting at 435 right now. If the bond market decides this oil move is structural, Powell's inflation is cooling script just went out the window.
Okay, so here's what the tape is actually saying heading into 2 o'clock. The QQs are barely green. Oil's still above 110, AMD's bouncing but it's fragile, and everything in this market is just waiting. Tom's right that this isn't belief, it's risk management. But the fact that you're seeing even a short covering bounce tells you the AI hardware story isn't actually broken in people's heads yet, it's just under scrutiny. If Powell holds the line and says inflation pressures are transient, this repricing is real and the hardware capex squeeze continues. If he blinks, if he signals anything softer, you get a relief bounce and everything rotates back. But raise the one holding the actual time bomb here. Oil at 110 is a consumer tax that's invisible until Q2 earnings season. And if the bond market wakes up and decides this is structural, not cyclical, then Powell's whole cooling inflation narrative evaporates. That's the real 2 o'clock question. The tape is hedging, not panicking. But it's watching very carefully to see if the Fed blinks on something that could be a lot bigger than semiconductor multiples. Ray, I want to get into what gold's non-response is really telling us, and whether Dimon's bond crisis warnings are starting to connect to this consumer drain story and what the yuan's actually facing this summer.
You know, yesterday I was staring at the Fed chart for real yields, the 10-year inflation-protected ones, and it just felt heavy, like the air before a storm. Oil hitting 110 is the headline, but the real story is the UAE basically saying we're out to OPEC. It's like when the one friend who actually pays for the group dinner decides to start their own table. It means the coordination mechanism is just fundamentally broken. We're moving from a managed market to a drill what you can market. And that structural shift is why the price floor is moving up, even if the headlines say everything is fine. And then you look at gold. The gold ETF was down nearly 2% yesterday, while everyone is screaming about Iran headlines. It makes no sense until you look at those real yields hitting 4.35%. Ray Dalio might want 15% of his portfolio in gold as a disaster hedge, but for everyone else, why hold a bar of yellow metal that pays zero when the 10-year is practically screaming at you to take its money? The market isn't actually scared of a war right now. It's just doing the math on the cost of carry, and the math says sell the shiny stuff. That brings me to Jamie Dimon, warning about a bond crisis. The man is the king of the storm clouds on the horizon speech. But here's the kicker. REITs went up yesterday while yields were climbing. Usually, higher yields are poison for real estate, but the fact they're rising tells you the market is actually calling Jamie's bluff. It's saying, we hear the warning, Jamie, but we're more interested in the fact that these buildings are actually full and paying rent. And keep your eye on the yuan this summer. Yesterday, I was reading about the dividend repatriation flows coming out of China. We're talking record amounts of cash moving back to global investors, which means everyone has to sell yuan to get their home currency. It's going to be a massive liquidity test for Beijing that has nothing to do with trade wars and everything to do with corporate plumbing.
That corporate plumbing is tens of billions of one-way selling into a managed currency. If they defend it, they burn reserves. If they don't, they import deflation into a system already short on demand. Either way, it stops being plumbing pretty quickly.
Tom, you just took my little plumbing metaphor and turned it into a horror movie, but you're spot on. The real tell is going to be the P-box footprint in May and June. But if they don't, that's the real nightmare. It means they're even more scared and don't have enough reserves left to try.
So what Ray just walked us through and Tom tightened up perfectly is this weird market where gold can't rally even with geopolitical risk because 4.35% real yields are just too good to pass up. But here's what I keep coming back to. That same yield story is what Dimon is warning could blow up. If the bond market actually breaks, if the Fed blinks, or inflation prints hot again suddenly, that real yield shield disappears and gold becomes the rational trade overnight. We're not solving the tension between war hedging and carry. We're just deferring it until Powell speaks. The market's calling Dimon's bluff today, but one hawkish surprise and the entire trade flips. Tom, though this is where it gets interesting. The mechanic behind why gold isn't rallying, why AI valuations are cracking under higher rates, and what Vale's actually telling us about where the commodity cost cycle goes. That's your sandbox. Let's go there.
The AI sell-off, it's being explained as rates up, multiples down. That's true, but it's incomplete. The mechanism is duration. These are duration assets pretending to be earnings stories. If you're paying 35 times forward for something like Nvidia, you're not buying next year. You're buying a stream of cash flows 5, 6, 7 years out. So the discount rate matters more than the earnings print. The 10 years at 4.35%, the 5 years at 3.98%. That 5-year is the problem, because the entire AI trade is implicitly underwriting that number back toward 3. You need about 100 basis points of relief to justify the multiple stack we've built. And instead, it's just sitting there. Now tie that to the reaction. AMD drops over 3% on a 3 basis point move in yields. If this were about realized productivity, actual ROI from AI spend, that move is noise. You wouldn't care. The fact that you do care tells you what the asset actually is. Then Vale. Same root issue, different expression. Commodity price goes up, you assume margin expansion. That's the model. Except the input stack is repricing at the same time. Oil at 110 feeds straight into diesel, electricity, freight. Labor follows. Equipment follows. So your revenue line lifts, and your cost base lifts faster. So both trades, AI and commodities, are being repriced by the same thing, inputs. For AI, it's the price of money. For Vale, it's the price of energy. In both cases, the assumption that something stays low is what's breaking.
That is such a clean way to bridge those two, Tom. It's the same squeeze hitting from opposite sides of the house. I'm thinking about the guy checking his brokerage app while he's at the gas station. He sees his Nvidia position melt because the cost of money is too high. And then he looks up and sees oil at 110 on the sign. If the AI bet is losing value and the life tax of energy is rising simultaneously, doesn't that just evaporate the retail investor's permission to be patient with the story?
Yeah, it does. But that permission was never underwritten by cash flows. It was underwritten by the idea that rates would fall and bail the whole thing out. That story just hit a wall, so the patience turns out to have been borrowed.
So Tom's nailing something really important there. That permission to be patient was borrowed. It was never about the fundamentals holding up. It was always about the rate cut story coming to your rescue. And right now that story is just stalled. Here's what ties it all together, though. Everything depends on what Powell says at 2 o'clock today. If he signals cuts are still coming, you renew that borrowed patience. The whole thing restarts. If he doesn't, everyone has to start paying it back at once, and you've got a duration asset with no narrative and input costs screaming higher. That's a different market. So let's talk about what actually moves the needle in the next few hours. What are people actually calling for? Okay, FOMC-day. Powell's got the mic at 2 o'clock, and everything we've talked about this morning, the AI bid, the duration trade, whether the Fed actually blinks, it all comes down to the next few hours. Here's my call. I'm calling the QQQs close red by at least 0.5% today. And here's why. If Powell holds the line, if he doesn't signal a cut and the market has to accept that rates aren't moving, the duration premium on mega-cap AI stocks gets repriced lower. We've had a beautiful pre-market bid on the assumption that he softens. I don't think he does. I'm wrong if the QQQs hold green through the close. That means the market read dovish in the statement or the dot plot. Tom, you've been all over the AI hardware thesis. What's your call?
Yeah, that's just duration admitting what it is. The 10-year closes above 440 today. I'm wrong if yields actually drop on the statement. That means Powell gave them something dovish to hold on to.
Tom, you're just staring straight into the sun today, aren't you? It's so clean. I'm going with the gold ETF. I think it closes flat to down at least 1% today. Even with all the geopolitical noise we saw yesterday, if the Fed holds firm on real yields, gold just loses its oxygen. I'm wrong if the gold ETF closes up more than 0.5%, because that would mean the market heard something from Powell that actually broke the real yield narrative.
So here's what's funny. We're all three betting the exact same horse today. You've got me fading the mega caps on duration. Tom's calling yields higher. Ray's got gold getting crushed. Every single one of us is sitting here saying Powell holds the line, rates stay elevated, and the market has to deal with it. We're not hedged against each other at all. But if we're all wrong simultaneously, if the QQQs close green and yields drop and gold rips, that's the market telling us Powell blinked. That's the market hearing something in that statement or the dot plot that changes the whole duration story. And honestly, we probably deserve it. We'll find out at 2. 3 clowns.